Okay, what a week in the markets. I mean, we just saw some absolutely wild action, especially wrapping up on Friday. Now, on the surface, it looked like this huge win, but trust me, when you zoom out and you look at the whole week, the picture gets, well, a lot more complicated.
So this is the big question, right? How is it even possible to have a day where the Dow just skyrockets, but the major indexes, especially the tech-heavy Nasdaq, still end the week deep in the red? That's the puzzle we're going to unpack today, this massive one-day rally that just couldn't save the week. So what's really going on?
And here it is, right here, in black and white. You can see the contradiction. On Friday, boom, a powerful rebound, the Dow jumps over 1%. But that just couldn't undo the damage from earlier. Look at that weekly number for the Nasdaq, down a painful 2.7%. That was its longest losing streak in months. It was, a classic market head fake. So you can really boil this entire week down to a massive tug-of-war. Seriously, you have two incredibly powerful and totally opposite forces pulling on the market. In one corner, you've got hopes of cheaper money from the Fed, and in the other corner, this growing fear that the whole AI boom has just gone too far, way too fast.
Okay, so pulling hard on the rally side of that rope was the hero of the day, New York Fed President John Williams. I mean, these words right here, they were so carefully chosen, and they basically screamed that the door was wide open for a rate cut, and that was exactly what the market was desperate to hear. It was like a shot of pure adrenaline straight into the veins of traders.
And just look at the reaction. It was immediate. It was decisive. Before Williams spoke, you see traders were pricing in, less than a 40% chance of a December rate cut. After he spoke, the odds shot up to 75%. I mean, that is a massive sentiment shift in just a few hours, and it's precisely what fueled that crazy buying frenzy on Friday.
But pulling hard in the opposite direction, and the real reason the week was so painful, was the villain of this story. This nagging, persistent anxiety that the sky-high prices of AI stocks are just not sustainable. I mean, after this incredible run-up, investors started getting vertigo, right? They're looking at these soaring PE ratios and wondering, wait a minute, is this the dot-com bubble all over again? And here you have it, the final scoreboard for the week. If you only looked at Friday's daily changes, you'd be celebrating. It's all green. But that weekly column, that tells the real story. It's just a sea of red. That impressive comeback on Friday just wasn't enough to undo the damage from those AI jitters earlier in the week. Now you better believe this volatility did not stay neatly contained in the stock market. Oh no. When investors get nervous, what we call a risk-off mood, the shock waves just radiate outwards. And boy, did they hit some other major asset classes hard.
The pain was just absolutely brutal in the crypto markets. Look at Bitcoin, the leader of the pack. It took a complete nosedive, plunging almost 9% just on Friday. It was a crystal clear signal that when fear takes over, investors dump their riskiest stuff first.
And it didn't stop with Bitcoin. Nope. Ethereum, the second biggest crypto, actually fell even harder. It tumbled a full 10%. This wasn't just a little sell-off, this was widespread panic, and it erased a huge chunk of the gains these assets had made all year. Now get this, because this is the crucial part. This wasn't just the big Wall Street traders moving money around. We're talking about retail investors sprinting for the exits. A staggering $4 billion was pulled out of crypto ETFs this month alone. That's a huge sign that the everyday investor is getting really spooked. And the pain wasn't just digital either. Key physical commodities felt the pressure too. Worries about a slowing global economy pushed crude oil down over 1.5%. And get this, even traditional safe havens couldn't hide. Gold slipped, silver tumbled. It just goes to show you how widespread this anxiety really was. So humming in the background of all this crazy volatility is something investors can just never fully ignore. This steady, low hum of geopolitical threats that adds a constant layer of caution to every single decision. And while none of these risks really blew up into a full-blown crisis this week, they create this really tense backdrop. You have ongoing trade disputes, you've got rivalries over resources, tensions in the Middle East. It all contributes to what analysts are calling financial fragmentation. And that's basically just a fancy way of saying the global economy is becoming less connected, more siloed, which makes everything a whole lot less predictable for all of us. Okay, so after a week of this intense tug-of-war between Fed hopes and AI fears, with all this collateral damage and this background risk, what's the actual takeaway for investors looking ahead? where do we go from here?
Well, the general feeling, the consensus, seems to be shifting toward caution. The advice is to think about rotating into more stable, defensive sectors, maybe trim some of those profits from the high-flying tech stocks, and maybe allocate a little bit to gold as a hedge. And crucially, it might be pretty smart to keep some cash on the sidelines, ready to go when new opportunities pop up.
And all of this, it leaves us with the billion-dollar question as we head towards the holidays, right? Was Friday's massive rebound the real deal? The start of a genuine end-of-year rally fueled by the Fed? Or was it just fool's gold? A temporary relief bounce in a market that is still deeply uncertain and, frankly, pretty fragile? I guess the next few weeks are going to tell the whole tale.